Welcome to the midweek update. For those who don't know me, my name is Phil Grandy. I'm CEO of philsgang.com. Also, I was named Entrepreneur of the Year in the United States, and I also made the Inc. 500 list of the fastest growing private companies in the country. I was also in Donald Trump's first book, which was an honor. Now I said all that, let's get to what's real important. Is the market going to crash or not? It's going to keep going? Well, it's interesting because remember, when we go back and take a look, what was one of the biggest problems that caused that 2000-2001 tech bubble to pop? Overvaluations. They got crazy. So, but guess what? Here we are. Remember, we had 5 tech stocks, big tech stocks back then driving that 2000-2001 dot-com bubble, and we got 5 stocks today driving the dot-com bubble. But remember, back then, those 5 stocks, they made up about 23-25% of the S&P. Today, it's nearly almost, 48%, so it's a bigger player. And Nvidia is the real problem, because Nvidia is a real contributor to the S&P. You pull that out, it collapses. I mean, the returns are almost, 24-25%. So you got one stock that's driving all the tech stocks and driving the whole S&P. If you pull that out, it's like an anchor, it's gone. And by the way, because we're already over 40-45%, almost 48% contributing to the S&P, the big tech stocks, without the tech stocks, the S&P doesn't survive. Now, but we're being told everything's wonderful. The economy's doing terrific. Don't worry about the tariffs. China's going to pick up the tab. So is in Walmart and the big box stores. That's going to be fine. And it's interesting when we look back and take a look at the dot-com bubble, and we're going to do that right now. Let me show you something on the chart. The S&P today has not been this overvalued since the dot-com bubble. In fact, if you take a look at 2001, look at the bubble here. Look at this red bubble right here. Look at that. We're almost there. We're almost there. Now, the big difference, again, as I said, back then you had Microsoft, Amazon, Cisco, eBay, Qualcomm driving the market, but they only made up about 25% of the S&P. Today, we got Microsoft, Amazon, but we got Nvidia, Apple, and Meta making up 46-47% of the S&P. That's a big difference, huge difference. And Nvidia is really, as I said, is the crucial part. I mean, that's like the anchor. So, but here's some other differences why we can keep going longer. We can take the bubble we're in right now and keep expanding and expanding and expanding it until it can't. Because here's the difference between now and in 2001. If you think about it, the money supply that they had back in 2001, let me show you here. Oh, this is interesting, too. They're telling us what a strong economy we have. Then how come is it that U.S. auto loan delinquencies are surging? Subprime auto loans, okay, are historic highs, and so are just your regular auto loans, your prime auto loans, both. We've never seen that before, not like this. That's another thing that you got to consider. So every time you hear how strong the economy is, no, that wouldn't be happening if it's strong. Now, so let's go to, again, the money supply. Because this is the important thing, because money supply is what's driving the market. If you go back here in 2000, 2001, the dot-coms, right here, see it? You know they only shoved in, between 2000 and 2001, about $5 trillion. Now, since the crash of 2008, okay, right here, about 2007, 2008, they went from $7 trillion, they shoved in 22 trillion, 7 to 22 trillion. Are you nuts? That's what, $15 trillion. That's how they're pushing the market up. Now, wait a minute, that's not the end of it. Also, stock buybacks. During the dot-com days, they only did less than $500 million in stock buybacks. We're at $6 trillion in stock buybacks. Now, let's go to the zero interest rates. They had very few zero rates. Since 2008 to 2025, 260 months, we've had 140 rates at zero or near zero. 140 months out of 260. You got to be nuts. So yes, that's the big difference. The money supply, stock buyback, zero interest rates. Trump keeps saying cut, cut, cut. That's what's keeping this bubble going. Now, they're all telling us how great the economy is. And the economy, they say, is great because of the labor market. We understand that. If you have a great labor market, got a strong economy, people go buy stuff, invest. But that's not true. Because since June of 2022 to now, we dropped from 10 million to 7 million. And if you look at discretionary spending, they're cutting back on airlines, cruise lines, fast food. All the fast food restaurants are closing, and casinos are dying. And gold is the best evidence. Gold is the best evidence because when gold goes up, think about this. The S&P only went up 8%. The gold miners is going up 60%, and gold itself is up 30%. What does that tell you? When gold goes up like that, it's telling you that they're worried. Investors are worried. They're nearer. They don't feel that there's so much uncertainty out there. So everything we're being told, how everything's wonderful, if you look at it, it's not. But remember, the market will continue to rally until it doesn't. So that's why you got to stay with your best stocks. And I'll show you those best stocks. To get my stock picks and learn how to trade properly, go to philsgang.com.